Welcome back to Mutual Fund Cafe. I have with me the best and brightest of the Indian mutual fund industry. I have with me Prashant of HDFC, Naren of ICICI, Mahesh of Birla, and Harsha of Kotak to talk to us about how they see the economy, the Indian corporate sector and the mutual fund sector itself performing. Well, Prashant, once again to start with you, do you think the Indian mutual fund investor now is a chastened or perhaps a wiser investor? I mean, we saw the rara years of 2003 to 2008 perhaps, a huge amount of NFOs, and then the big cleanup that came, or supposed cleanup that came from the regulator, and then the downturn in the markets itself. At a personal level, I saw my wealth deteriorating, the NAVs falling. But do you think this up and down has given people the wisdom that you always invest in SIPs? Can we expect that lesson has been learned?
Yes and no. I think some people have learned, but a lot more are yet to learn.
Okay.
Because, I mean, just to give you a sense.
You have the finger on the pulse of the investor. Do you think it's been learned?
See, I think, I mean, I have seen over the last 20-25 years that a section of the investors are maturing once they have experienced how equities behave. But in India, the penetration of mutual funds, the size of mutual funds is simply minuscule compared to the potential. So last year we collected $10 billion. But what is our household savings? It is $500-600 billion. So 1 to 2% of household savings have gone into funds. That's it. Over last 5 years, the cumulative inflows are zero. We imported gold worth $200 billion in the last 4 years. And mutual funds are zero. So I think, yes, a section of people, but a very small number of Indians have understood the potential of equities. And I think, but it's a section is improving. I mean, that's why the mutual fund industry has grown and come over the last 2 decades. So I would say it's a long journey and we are still in the initial few stages.
Can we take longer strides now in terms of more financial savings coming to the mutual fund sector, Naren? You know, for one, hopefully we have corrected inflation for a slightly longer term. Hopefully, therefore, the importance of financial savings over real economy savings has been understood. And now there are payment banks, probably Jan Dhan and Aadhaar. Are you getting a sense, therefore, that a broader set of people can come in?
Certainly, I think there is no doubt that we have managed to expand the base. And I think if the industry manages to sell products like the balance category, which are certainly lower risk than the equity category, those kind of pushing along with SIPs and those kind of models could lead to a big expansion in this industry. And
you're seeing your community reaching out beyond the tier 4 cities, I mean the 4 tier 1 cities?
Certainly, it has gone much wider than the top 15 cities, and thanks to the encouragement given by the regulator and the investor education programs that we have done, again thanks to what the regulator has done, has helped us to move forward. But there's a huge scope, as Prashant said. We are just scratching the surface. But if we sell the most aggressive products, then the industry will not expand to the same extent. And that is something that the customer and the distributor also has to remember, that at some point of time in 2007, by selling only infra funds, the industry suffered. So I think it's very necessary to actually sell the more moderate return, lower risk products. Even though it may be very tantalizing to invest in the highest return 1-year funds, I think it's very important to sell the moderate return products, because they can give a much better investor experience over a period of time. Then 2008 kind of situation can be handled better.
I mean, I guess the industry has to mature first before the investors into the industry maturing. That always happens. But Mahesh, like we've been noticing, DII flows, domestic investor flows, are kind of able to buffer up even when foreign flows move out. Would that be a trend for FY16?
Yeah, I think we have seen, as I mentioned rightly, I think we have seen now domestic investors participating. And in the last 15 months, we have seen steady inflows. I think every month we are receiving around 5,000 to 6,000 crores of money into the mutual fund side. And I think more importantly, I think what you're seeing is that other asset classes, it's also a balance. I mean, savings go into various asset classes, physical and financials. And the alternatives, okay, for investors at this point in time are very few. And the fact that the equity is also, as the other participant mentioned, and the awareness is increasing, okay, compared to what it was, say, in the last cycle. I would say this time around the awareness is much higher, even from the mutual fund participants, in terms of the money which is spent in investor education. And there's a big budget which is there, more than around 300 crores which the industry spends on investor education. And also trying to penetrate the market into newer, not only the top 4 cities, but also beyond that. I think this time around, I think you will see a wider participation of investors in this cycle. I'm assuming this cycle will last for another 5-6 years. Okay, given that and the fact that the ownership of equities is very low. Okay, if you look at in the last 7 years, it's come down further. So need to rebalance that. I think you would see more savings coming into mutual funds in the next few years. And that, I think, would be a big power to counterbalance the FIs, because we know until now, I mean, FIs, I mean, the market has been kind of dependent by FI flows. I think that counterbalancing factor from domestic savings is going to be important phenomena which you would see in the coming years.
But what about the immediate term? I mean, over 2-3 years, base will expand. But Harsha, 1 or 2 or 3 months or even 2 quarters of, say, falling NAVs, do you think that can still turn the investor fickle? Or do you think at least this year we should be able to, tide over this because of at least hope?
No, I think for the last 2 quarters we have seen markets have remained volatile. They have remained volatile going nowhere. I mean, if you look at the margin of a movement from a point to point, it's not much. So in effect, investors have seen volatile times, but the money flow into mutual funds is continuing. So I think this time around investors are a little more mature, or at least we hope that they have become a little more mature and look for at least 3 to 5 year kind of investments in equities, if not more. And
so
also
this 5,000 monthly run rate, you think should not be in danger?
At least for now it's continuing. Even if there is some aberration, I don't think it should impact the markets, because the insurance flows, which were always on the negative side for last several quarters, have started to moderate a little bit. So I'm not saying that they will start to get inflows, but at least the selling pressure from insurance is reducing. And also you have new segments which are likely to come into equities. For example, the PF and the EPFO money, which could come into the markets going forward, which is certainly long only kind of money. You will not see them trading in equities or moving money out of equities. So that will give a kind of counterbalance to overall flows as well.
Okay. Well, now let me come to, the sectoral performance. It's not rocket science that all the fund managers here would have about 30% of their money in the banking space. Prashant, the perennial trend we get from, or the repeated statement we get from everybody is that you trust private sector banks more. But now public sector banks have fallen to fairly attractive valuations. Would you say that that would be a segment that will turn around, or do you think that there is still a lot of pain left?
See, I would rather go by what the bankers are saying, and they said that current year should be better than last year. And economy is also showing signs of improvement. We think the capex cycle will recover in the current year. So I think on the margin, every year including the current year should be better than the previous year going forward, in my opinion.
Okay. Naren, your call on the banking space. I mean, I'm asking you specifically about public sector banks because at least lately they have not been the favored lot.
So I think the next 1 year, as this infrastructure problems get resolved, once they get resolved, after that they are going to be in a very sweet spot. With reducing interest rates, they have a good treasury book. But I think near-term volatility in that sector is still likely till we know what happens to the non-performing loans, particularly because what has happened in the recent past is many of these leverage companies' market caps have become very small relative to their debt. So consequently, their ability to issue equity to actually deleverage is almost not there at this point of time. So that has become a problem, that you cannot raise equity and deleverage.
That's right.
We were hoping last year that that cycle could happen, but that cycle now doesn't look like happening. So that's why I would say, if you look at the near term, there is scope for volatility, and that is how we are reading it. Having said that, from a valuation standpoint, the top public sector banks are really attractive, but the risks are also there.
Okay, my note says, while everybody else is bullish on banking, you are a little contra when it comes to banking. But you're very bullish on IT, Naren. and this time the IT results kind of wobbled. Do you think it will continue to be an attractive sector in the days to come, or do you think it's going to lose its defensive character, so to speak?
See, first was the call was post the results, and post the results the stocks had come down to pretty attractive levels. And if you see the way currency has behaved, it was not possible for the currency to remain continuously stable against all the other currencies, because you know all your imports were taking over, and you knew that currency had to depreciate. So that was the second call. And if you look at the quality pack, if you compare the consumer and the pharma names with the technology names are clearly much cheaper on a valuation standpoint. So we felt that it was the most safe defensive sector at this point of time. I agree you can't make mega returns in the sector, but then at this point of time neither the consumer nor the pharma sector was also looking cheap that we could look at it. That's how we looked at the sector.
What would be your sectoral preference, Mahesh?
No, I think I would say that in the banking space, I think if you look at the private sector banks, I mean, they have been showing steady growth. Even last year, okay, when we have seen the credit growth was not that good. So I think good banks, private sector banks, I think will continue to grow and show a steady growth. Now that the recovery in the economy would be much better in the coming years, I think they will show a steady growth. I think that's one area I think which we like. Besides that, I would agree IT at this point in time looks pretty reasonable in terms of valuations, though I think the growth might not be very, I mean IT should report around 14-15% kind of a growth. So kind of neutral over there. I think consumer discretionary is one sector I think which we would like to bet over the next medium term, long term. Again, as we see urban consumption start to pick up, okay, I think that will drive some of these stocks. Also some cut interest rates, though we don't expect too much. But as the broad economy starts to move up, I think that's an area, and a lot of companies in that space having good brands and pricing power would see that benefit coming through much stronger at the bottom line. So that's one area which I think can show a significantly higher growth in the next few years. That includes media also.
Okay. Harsha, your preferences?
Currently we are overweight on auto, cement and consumer durables. I think these are the sectors which are early recovery plays, and we are already seeing some amount of growth in at least some of the sub-segments or some of the regions. For example, within the auto sector, the passenger cars, sub-segments of two-wheeler and commercial vehicles have started to show some amount of volume growth. And in the downturn, the companies have really streamlined their operations. So that operating margin leverage will start to kick in as the volumes improve. And they don't have too much of debt on the books. So there is no worry even if the interest rates don't come off substantially going forward. Similarly, with some of the well-run cement companies, I think there is hardly any leverage in the companies. And we are already seeing some investments happening from the government, and if private sector investments also start, and if there is some stability in the real estate sector, you can really see higher growth coming into the cement sector. And what is more important is over the last 3-4 years, most of the capacity pipeline is already built in, and you are not seeing incremental capacity coming into the sector.
Okay.
So incrementally as demand improves, this sector is going to see higher pricing power, and that's what we are betting on. And consumer durables, once again, it's a sector which is more cyclical compared to even auto, because the ticket sizes are relatively small. And we are already seeing significant growth there. And we continue to believe that that will continue at least for a better part of next few years.
What would be your sectoral hierarchy, Prashant?
I think the companies related to the capex cycle, I think, should do better in this cycle, and that could include corporate banks, both in the public and the private sector. It could include engineering companies, and I would agree that even the outlook towards consumer discretionary is quite good.
All right, gentlemen, hold on to that thought. We have a lot more questions for our mutual fund experts. We are back after a very short break. Stay right there.